The money market is the wholesale market for short-term, low-risk, highly liquid debt. In reality, it is not a single market, but a collection of many markets involving a broad range of instruments. Its markets include the market for U.S. Treasury bills and U.S. government agency securities, the market for municipal notes of state and local governments, the market for commercial paper issued by corporations, the markets for bank deposits and bank reserves, and the markets for specialized instruments like bankers' acceptances and repurchase agreements. It is also a market that includes a broad range of participants, all heavyweights in the financial markets. These include the banks and central banks of the U.S. and global banking systems, major corporations, and institutional investors such as the money market funds. The money market serves a number of important functions. It provides cash management instruments that help users borrow or invest funds for short periods. It provides a means of transferring reserves within the banking system, ensuring that funds are sent to where they're needed most. And it provides the Federal Reserve with its primary arena for implementing monetary policy. The U.S. domestic market is obviously located in the U.S. with a center in New York. The Eurodollar market is largely centered in London. As you can see, there are several instruments found in both the domestic and Eurodollar money markets. However, as you will discover later in this course, regulatory and other differences in the markets may cause these instruments to differ slightly in their features. The U.S. domestic market is closely regulated by the Federal Reserve and the Securities and Exchange Commission, the SEC, while the Euro market is subject to little or no regulation. Over the years, the Fed's ability to impose reserve requirements and insurance premiums on domestic bank deposits has at times significantly affected the competitiveness of domestic bank deposits. Click on Reserve Requirements and let's explore this further. The Federal Reserve requires that a specified percentage of a bank's deposits be retained in the bank's reserve account at the Fed. Because these required reserves cannot be loaned out, and because reserve accounts are not interest-bearing, banks face an additional opportunity cost on any funds raised by accepting deposits. Banks are also required to pay an FDIC insurance premium on the entire amount of these deposits. As you can see, there are currently no reserve requirements on non-personal time deposits and no FDIC premiums for well-capitalized banks. In the past, however, these have been a significant cost to banks. Go on and let's calculate what the cost of reserve requirements is. Let's examine this situation. Here are two CDs, one issued in the domestic market at 8% and the other issued in the Euro market at 8.25%. Which CD gives the issuer the cheapest funds? Calculate the all-in cost of funds for these two options. As you can see, there is a significant increase in the cost of funds. During periods when reserve requirements existed on CDs, banks sometimes found it difficult to make their CDs competitive and to raise funds at reasonable cost. There are usually slight differences in the domestic and euro rates for similar instruments. Considering the nature of these markets, what do you think are the causes of these differences? Actually, all the items listed here have caused differences in rates. If you'd like further explanation of any answer, simply click on the item. As you discovered earlier, regulatory requirements impose an opportunity cost on domestic deposits that make it difficult for domestics to match euro rates. Euro deposits are subject to the regulations and laws of whatever country they are located in. For dollar deposits held by UK banks, this is not considered a significant risk, but in some other centers it has been an issue. Some euro markets are less active than their domestic counterparts and therefore offer less liquidity. Foreign banks and corporations sometimes find that they are better known and can therefore get better rates in the euro market. Despite their differences between the domestic and euro markets, the active arbitrage that goes on between them, particularly the market for bank deposits, keeps the rates quite close. Over the years, as the Fed has reduced or eliminated reserve requirements and rate limits, the spread between the two markets has narrowed to the point where it is quite small. The difference between euro and domestic rates in the money market tend to be significantly less than the differences in rates found in the bond market because of the short maturities involved. You are correct.